If you're planning to retire in the next 10, 15, or even 25 years, there's one decision that will make or break just how wealthy you'll be when you get there. And it's not how much you save, it's how you invest. Now, with so much riding on it, you'd think that investing would be backed by solid, time-tested research. You'd expect the entire financial service industry to follow this evidence. And you'd assume that most bankers, wealth managers, and advisors were using these proven, evidence-based strategies to help all of their clients succeed. Well, based upon decades of experience within the family wealth profession, here's the truth. This academic research absolutely does exist. It goes back to the 1950s and it's peer-reviewed, and many of the people behind it have won Nobel Prizes. Nobel laureates such as Eugene Fama and his efficient market hypothesis, Kenneth French, who developed the Fama-French three-factor model, or Robert Merton, Myron Scholes, and the 2022 winner Douglas Diamond. But the problem is that most of the traditional financial services industry completely ignores this evidence. Here, private bankers, brokers, and traditional advisors typically push somewhat opaque, somewhat expensive, somewhat flawed products and outdated approaches that predominantly reward them and not you. Now, I know many of these people, and they're often very charming, very likable, and even well-meaning. However, when their entire livelihood depends on them not fully understanding or just admitting things, it's understandably quite hard to get them to overcome some of the hidden conflicts that things such as disguised remuneration or commission incentives may potentially cause. Now, in stark contrast to this, a tiny number of certified investment fiduciaries or trusted guys scattered around the globe follow an entire plethora of highly prudent practices, a PDF of which can be downloaded in the link below, to share the wisdom, academic research, of how to exactly navigate around this traditional industry and invest better and follow the evidence of what actually works and is absolutely in your best interests. So I'm going to create a series of videos to help investors make smart, sensible decisions. And I'm going to start this off today by showing you what real investing for wealthy, successful families actually looks like. The biggest myths that quietly drain your wealth, some of the investment challenges that we all face, and how to begin to consider putting in place a truly robust investment system for yourself. But first, and to put all of this into context, I want to tell you a story about the evolution of investment with reference to the telecoms industry. Because just like investment science, telephones have evolved a huge amount in just my own lifetime. So when I think back to the early 1980s and my grandmother, I used a traditional old dial-up telephone. I learned to invest from my grandmother. She'd sit there at the breakfast table and read a newspaper based upon the out-of-date information within that and how she was feeling that day. She'd use that out-of-date telephone to dial up a smartly suited stockbroker to buy some stocks or shares, which are little slices of ownership in firms such as British Petroleum, Woolworths, or Marks and Spencers. Now, that smartly dressed stockbroker would then execute the trade and post us some contract notes in the Royal Mail, which would arrive a few days later. However, today's evidence shows that stock picking is extremely hard to get right, even for full-time professionals. You win some and you lose some of these largely speculative bets. On average, a stock picker typically receives returns far lower than the overall market. Now, just after this, I remember my father at the end of the 1980s coming home with the first car phones, and a few years later I was playing Snake on the Nokia 3310. Around this time, my father explained that Fidelity had created funds, mutual funds, that contained lots of the little stocks or slices in companies that my grandmother had been buying. And these mutual funds invested in things such as North American equities or Brazil, Russia, India, China, or technology funds. They were more diversified than the individual stock bets, and this greater diversificational risk management meant better than average performance. And this helped propel firms such as Fidelity to become the world's largest non-banking financial services institution. So the investment industry had evolved. Now, Back to technology, and when I started my professional career, everyone had a BlackBerry. Phones had moved on from Nokia's, and so had investment science. Great firms such as Vanguard and BlackRock's iShares replaced these active mutual funds, which by this stage had proven both costly and prone to human error of the fund managers, and they replaced them with something called index funds. These further improved average returns as they only lagged the overall return of the market by tracking error and cost. 20 years later, my children tell me that we're now on the iPhone 16 and iOS operating system 18.5, and the Nobel laureates have provided the evidence that certain factors within these index funds may produce higher expected returns, and that a systematic approach to portfolio construction may capture these premiums, optimizing your expected long-term return. So the punchline of this story is that iOS 18.5 won't be the last software update, and I'm sure that we'll also get an iPhone 17 in time. If I don't continuously update my operating system or my phone, I'll potentially get some type of suboptimal outcomes. Now, investment science evolves just as quickly as phones, but many people I meet day in and day out don't ever update their investment mindset and their operating system or the way they think about investment. Many of them speculate still and trade in and trade out of markets, just like my grandmother did in the early 1980s. Some let their capital languish in the relatively expensive and underperforming active funds typical of the 1990s. Some are evangelical about the blind dumb index funds, like I was once, and BlackBerries. Very few people stay abreast of investment science or even have an awareness about evidence-based or systematic investment. And this causes extremely expensive financial drift, which silently erodes your future wealth enjoyment. Now, back to what real investing for successful families is and what it definitely isn't, because the traditional financial service industry conditions many people to wrongly believe investing is about spotting the next big opportunity, picking winners like my grandmother, forecasting, beating the market, timing your market entry or your exit just right. But this mindset is exactly why many investors underperform and get disappointing experiences. It's not just statistically been proven as ineffective, it can be extremely damaging to your financial future. But this life-transforming damage is extremely hard to measure to the untrained eye without clever computer programs that work out the compounded cost of the consequent financial life drift over your entire lifetime. Wise investing is something very, very different. It's not at all about trying to get lucky, speculation, or trying to outsmart the market. Successful family stewards, such as senior executives, top professionals, and business owners, should instead think about investing as the long-term process of preserving and growing your future purchasing power in order to fund the lifestyle and the personal choices that you want. That could mean things such as retiring early, spending more time with your family, giving to people or causes that you care deeply about, or just having the freedom and independence to do what you want, with who you want, when you want. Whatever your goal, investing is the mechanism to accelerate wealth creation and get you there faster, because not investing means that the value of your money actually goes backwards. And this is because of inflation. You can't see it, smell it, or feel it, but given enough time, it will decimate your future net worth. Whilst cash in the bank might feel safe in the short term, in the present, it's actually invisibly rotting away your future wealth and your life goals. Investing wisely with an up-to-date operating system stops the terrible financial drift this can cause in its tracks. Investing wisely is a slow, sometimes frustrating, and emotionally painful or challenging process that requires a well-thought-out plan executed over many years with patience and discipline. This is exactly what many people get wrong. They treat investing like gambling. They chase whatever's hot. They react to headlines on the news. They try to jump in and out of markets, predict what's going to be coming next, and get really impatient at exactly the wrong time. These are all very human emotional errors, which reminds me of the quote from a brain scientist's personal journal. Most of us think of ourselves as thinking creatures that feel, but we are actually feeling creatures that think. I once knew an investor, a high earner, very sharp guy who came to us after years of picking his own stocks. He'd had a few big wins early on and got hooked upon the exhilaration or dopamine. But as the years passed, he had an uneasy feeling in the bottom of his stomach that his performance just didn't quite stack up. And when we ran his choices through our analytics software, the compounded opportunity cost of unconscious drift caused by his suboptimal decision-making ran into the many millions of pounds. So, how do you begin to put an end to drift and suboptimal financial life management? The challenge facing all investors and their advisors is there are no absolute right or wrong answers in investing. There are, however, some solutions that are much better than others. Investment decisions should always be made in a framework that is robust, evidence-based, and founded upon a rational and a defensible investment philosophy. It's obviously extremely hard to repeatedly make wise, high-quality decisions without any defined or documented process. Poor quality investment decisions often lie in a lack of awareness, so I'm going to teach you a simple 4-step process to help ensure your operating system is always completely up to date. Step 1 is to build the foundation, ensuring you have access to up-to-date Nobel Prize winning research and investment theory. Step 2, define a philosophy that you're actually happy with. Establish an evidence-based philosophy that distills the up-to-date academic theory. Step 3, implement wisely, building and maintaining a robust, smart portfolio structure. And step 4 is governance, ongoing good governance and risk management. Let's now examine each of these steps in a little more depth. The goal for the foundation is to ensure that where you require an investment portfolio solution to reach your future life goals, you make wise decisions that offer you a great chance of a successful investment experience across a wide range of uncertain future economic environments. This means reviewing academic evidence and theory, ideally the peer-reviewed academic and Nobel Prize-winning theory that hangs around in universities such as Harvard, Yale, or the Chicago School of Business, not in brochures on Wall Street. But research is only the very first part. Think of it like planning a long road trip. Having a detailed map or even a GPS is essential, but would you drive through the night with your headlights off just because you know the route? Of course not. You still need visibility and judgment along the way. And this is where your family's investment philosophy statement comes in. It acts just like your headlights, helping you to stay on course when the economic environment, the conditions change or challenges appear. This philosophy is all about agreeing on your set of beliefs that guide your decisions, especially around risk. It helps you stay disciplined and focused even when markets are volatile. These beliefs form the backbone of your investment process and should reflect principles such as a confidence within markets, a recognition of where returns are expected to actually come from, and the link between risk and expected return, patience and discipline in compounding your wealth over time. Codifying this philosophy, formally writing it down, ensures clarity, consistency, and alignment, especially for families stewarding wealth across generations. It's exactly what transforms academic theory into intentional action. A deeper look at step 3, that is, implementation, would be to systematically filter the entire investable universe to find possible matches against the investment policy statement. Here at AES, we typically begin with the Morningstar Global Universe of over 800,000 funds. That's everything available in the market. From there, we filter this using a strict rules-based process. We prioritize statistical evidence, diversification, low costs, transparency, liquidity, and most importantly, alignment with specific investment goals. That universe quickly narrows to a long list of around 10,000 funds. Then a second layer of screening cuts that down to a watch list of around 100 to 200 funds. Here you can see an example of where we've set the filters from our investment philosophy around the benchmarks that we've selected around cost, diversification, risk management, and strategy. From there, we review in detail and run enhanced due diligence on a handful in each category, maybe 1 to 3. And only then do we have a discussion around the various different trade-offs between different options and or recommend a robust portfolio. So, forget picking funds based upon your favorite brand, performance charts, or slick sales pitch. Focus instead on structure and rigor. Use objective, intentionally chosen filters and let the evidence, not opinion or emotion, drive all of your decisions. Investing is characterized by both uncertainty and complexity. Ad hoc investment decision making without a suitable framework for reference is prone to carry inappropriate risks in the portfolio and emotional pressures to make knee-jerk suboptimal decisions in response to short-term market events. Step 4, governance, is all about ensuring the process remains consistent and accountable over time. It includes regular reviews, risk monitoring, adapting to new evidence and market developments, and course correcting whenever needed, all without abandoning your core philosophy in your investment policy statement. It's the backbone that keeps everything else working long after implementation. A disciplined and well thought out process materially reduces unwanted and unrewarded risks. In an uncertain world, a good process should deliver deserved success, but it does not and cannot guarantee it. Unfavourable outcomes will still occur from time to time. However, the likelihood of success with a good process is far higher than that of a bad process, where good outcomes are potentially just the result of luck more than anything else. You can see this in this table here, which is all about the importance of a really good, robust underlying process. A good process and a good outcome typically give deserved success over time. A good process and a bad outcome is likely a short-term bad break that you'll get through over time. A bad process and a good outcome might be described as dumb luck and can be extremely dangerous over time due to the cognitive blind spots, such as overconfidence that it can create. Whilst, sadly, a bad process and a bad outcome is best described as poetic justice. A wide number of important decisions are always faced when constructing and implementing a wise investment strategy, from the decisions around which risks to take through to which products capture those risks most effectively, individually, and at the portfolio level. Your confidence in the balance of evidence presented, combined with the probability and impact of being right or wrong, helps to provide guidance on which decision path to follow. Finally, establishing a robust investment proposition is by no means a set and forget process. Great ongoing governance is the key to long-term investment success. Evolving the process over time as new investment theory, empirical evidence, and implementable investment opportunities arise, just like those telephones and operating systems. Updating things is a core part of any sensible process. These 4 steps, anchored in evidence, discipline, and governance, are what set successful family investors apart. They're not just theories. Their structured way to cut through noise, avoid costly mistakes, and to build real, lasting family wealth. If you found this video helpful, do like, comment, or subscribe. It really helps us as we build this channel and helps us reach more people like you and means that you won't miss the next step in this series. Because understanding how to invest wisely is just one part of the overall puzzle. Once you've got a powerful investment engine, at least 90% of your future lifetime investment return will be driven by, firstly, the primacy of a robust financial plan or life strategy. Secondly, by how much of that investment engine is allocated to equities as opposed to fixed income or bonds. And thirdly, whether or not in response to some extreme market fad or fear, you break faith with the plan or life strategy and behave your way off the optimized green line. Even the best portfolio can't help you if you're saving or behaving in the wrong way. So, if you're serious about building long-term wealth, don't miss the next video where I'm going to show you exactly how the wealthiest 1% actually save for retirement. You'll learn how they protect their income, reduce tax, and stay decades ahead of the average investor.